Learning Objective 3 is to prepare schedules of cost of goods manufactured and the cost of goods sold and income statement. The schedule of cost of goods manufactured include three elements of costs mentioned earlier: direct materials, direct labor, and manufacturer overhead. It calculates the cost of raw material and direct labor used in production, and also the amount of manufacturer overhead applied to production. It also calculates the manufacturer costs associated with goods which were finished during the period. To create a schedule of cost of goods manufactured, it's important to understand the flow of product costs. So let's take a look at the product cost flows. This is the equation of raw materials. If we have beginning raw materials inventory plus raw materials purchased, and we can get raw materials available for use in production minus ending balance, we can get raw materials used in production. For raw materials used in production, if that's direct materials, we include it as manufacturer cost. We can also use a tier count to show the process here. We have beginning plus purchases minus ending. You can get the amount of used raw materials. The textbook defines that as items are removed from raw materials inventory and placed into a production process, they are called direct materials. But keep in mind, if there are indirect materials used in production, we should also subtract indirect materials from raw materials. And indirect materials should go to manufacturer overhead. In addition to direct materials, direct labor and applied manufacturer overhead should be also included in manufacturer costs. So those three together, direct materials, direct labor, and manufacturer overhead applied, are total manufacturer costs or product costs. The sum of direct labor and manufacturer overhead applied is called conversion costs. These costs are used to convert direct materials to a finished product. Total manufacturer costs are added to beginning working process inventory to get a total working process for the period. When products are finished, the cost of products finished will be transferred from working process to finished goods inventory. It's called cost of goods manufactured. If we take a look at the working process equation here, we subtract ending working process inventory from total working process for the period. We can get a cost of goods manufactured. If we take a look at tier count of a working process, beginning plus manufacturing costs, including direct materials, direct labor, and applied manufacturer overhead, minus cost of goods manufactured, we will get ending balance. Cost of goods manufactured will be transferred from working process to finished goods. For finished goods equation here, if we have a beginning finished goods inventory count plus cost of goods manufactured, we will get cost of goods available for sale minus ending finished goods inventory, we will get the cost of goods sold. This equation is for manufacturing companies. It's quite similar to what we've learned in Intro to Financial Accounting class, merchandising company's inventory equation. Beginning balance of inventory plus purchases. Here I get total cost of goods available for sale minus ending inventory. Here I get cost of goods sold. Let's take a look at the account for finished goods. If we have beginning plus cost of goods manufactured, transferred from work in process, minus cost of goods sold, here I get ending balance of finished goods. Learning objective 4 is to calculate underapplied or overapplied overhead cost and prepare the journal entry to close the balance in manufacturer overhead to appropriate accounts. For manufacturer overhead, we mentioned the left-hand side of a manufacturer overhead is actual amount of MO. The right-hand side is applied MO. To get applied MO, we use predetermined overhead rate multiplied by actual level of allocation base. Well, in practice, actual MO won't be the same as applied MO. So in accounting, we define the difference either as overapplied or underapplied. Let's take a look at it here. If applied MO is more than actual MO, this is overapplied overhead. If applied MO is less than actual MO, it's called underapplied overhead. That's a definition for underapplied or overapplied overhead. Well, what do we do with underapplied or overapplied overhead? We have two approaches. Here in the class, we will just talk about approach 1, but skip approach 2. And of course, no homework or no test related to approach 2. Let's focus on approach 1. We will allocate the difference to cost of goods sold. It's very straightforward. It's just one account will be related to overapplied or underapplied manufacturer overhead. Let's say for 30,000 difference, we need to close to cost of goods sold account. In accounting, closing means the ending balance at end of accounting period will be 0. We want to close it to 0, or we want to make it 0. That's closing process. Generally speaking, temporary accounts will be closed, such as revenues, expenses on income statement. But for permanent accounts, which are assets, liabilities, or shareholders' equity, on the balance sheet will not be closed, which means the previous period balance will be carried into next period. Here, manufacturer overhead is also a temporary account. That's why if there's any balance at end of a period, then we should close it. In approach 1, we close it to cost of goods sold. Let's take a look at a specific example. Perrico's actual overhead for the year was $650,000 with a total of 170,000 direct labor hours worked on jobs. How much total overhead was applied to Perrico's jobs during the year, and use Perrico's predetermined overhead rate of $4 per direct labor hour. To calculate applied MO, we use predetermined overhead rate $4 multiplied by actual level of allocation base. Here, actual direct labor hours used for jobs, 170,000. So we can get total applied manufacturing overhead, 680,000. Now take a look at actual overhead, 650,000. Applied overhead is more than actual overhead. So this is over applied overhead. Let's take a look at the account for manufacturing overhead of Paraco companies. On the left-hand side, that's actual overhead costs, 650,000. And we have applied overhead, which is calculated, 680,000. Again, applied overhead is more than actual, so it's over applied. You can see here on the right-hand side, 680,000 is more than 650,000 by 30,000. So just take a look at the ending balance for manufacturing overhead. It has a credit side balance, 30,000. This is over applied overhead. Okay, now we need to close it. When we say close the account, we are saying we want to make it 0. Manufacturing overhead account right now has a credit balance, 30,000. We want to make it 0 on the credit side as well. Okay, that's called closing. So we want credit side balance 0. To get 0 on the credit side of MO, only if we debit MO account, we can get 0 on the credit side. Again, when we say closing or close account, we're saying we want to get the balance of 0. Right now, manufacturing overhead has a credit balance 30,000. It's over applied overhead. So we want to close it. We want to make it 0. To get a 0 here on the credit side, only if we debit MO 30,000, we can get 0. If there's any debit, there must be a credit. And then we need to close it to cost of goods sold. So we debit manufacturing overhead 30,000, and then we credit cost of goods sold 30,000. The journal entry here, we debit MO and credit cost of goods sold. That's approach 1. If there's any over-applied or under-applied overhead, we close it. We close the balance to cost of goods sold. And this is over-applied. So we debit MO, we credit cost of goods sold. If that's under-applied overhead, we will do the opposite journal entry. Well, let's do a quick question here. What effect will the over-applied overhead have on Paraco's net operating income? For over-applied overhead, we just did a journal entry here. We debit the manufacturing overhead. We credit the cost of goods sold. Cost of goods sold is expense account. Credit side means decrease side. So cost of goods sold decreases. Okay, what's the impact on net operating income? To get net operating income, we start from sales minus cost of goods sold for manufacturing companies, minus operating expenses such as selling administrative expenses, and we can get net operating income. Okay, cost of goods sold is a typical expense. So if we take a look at here, cost of goods sold decreases. right, goes down because of a closing from over-applied overhead to cost of goods sold. We subtract less expenses from sales, so net operating income increases. The answer is A. Let's go back to Smith's example. Manufacturer overhead, we just calculated, applied MO, 17,500. And the company has incurred actual MO. If we add up 3 total here, you will get 20,600. Applied MO is less than actual MO. So in this example, it's a under-applied overhead. The balance here for manufacturer overhead is on the debit side. The difference is 3,100. To close it to cost of goods sold, we want to make it 0 on the debit side of MO. Therefore, only if we credit 3,100 to MO account, then we can get ending balance of MO on the debit side 0. If there's any credit, there must be a debit. So for this closing journal entry here, we need to debit cost of goods sold, 3,100, and credit manufacturer overhead, 3,100. Okay, this is Chapter 3. Chapter 4 introduces a new costing system, process costing. We will skip the chapter, but please read these 2 pages, page 148 and 149. It talks about the similarities and differences between job order and process costing systems. And this is a table summarizing the differences between job order and process costing. I will not go details, but just read through the differences, and if you're interested, you can read chapter for yourself. But for our homework or exam, we will skip chapter 4.